Hey guys, I hope you all are doing great. So I'm Arvind, I'm a chartered accountant, and today we're going to be looking at a very interesting concept in finance, the fund flow statement. So guys, if you're new to this channel contains concepts on finance and concepts on how audit works in the real world. So what are you waiting for? Do stay tuned and do subscribe to the channel, and let's move on to the video. So guys, so you would have heard of balance sheet, profit and loss account, and even the cash flow statement. But what is a fund flow statement? Guys, before understanding what is a fund flow statement, let me break down a balance sheet for you. Guys, so to put it in simple words, what does a balance sheet contain? A balance sheet contains assets on one side and the liabilities on the other side. So basically, a balance sheet conveys the balance of the assets as on a particular date, usually 31st March, and the balance in relation to your liabilities as at 31st March. So this is what your balance sheet actually conveys. So if you look at your balance sheet, your liability side, let's take your debenture holders, or let's take your loan providers, or let's take your creditors. What do? Your loan providers provide you funds because you want to invest these funds for a particular purpose. So where do you invest these funds? Let's say you invest them in your fixed assets. Where would this appear? This investment would appear on your asset side. And let's say you procure goods from your creditors. And why are your creditors outstanding as the balance sheet date? Because you've not paid the amount for the goods purchased as on the balance sheet date. And using the goods purchased from your creditors, you will process the same into inventory and you will sell them to your customers. And till the time you receive the amount from your customers, the amount will be parked in your balance sheet in the form of debtors or trade receivables, right? So basically, from the explanation I've given you, you can simply understand that whatever is appearing on your liability side is actually a source of finance. That is, your debenture holders or your shareholders or your creditors are finance providers. And whatever is appearing on your asset side is basically an application of the funds which your fund providers have actually given to you. So you can basically say that your liability side is your source of fund and your asset side is your application of those funds. So guys, basically what a fund flow statement does is that a fund flow statement basically helps you in understanding what is the quantum of sources of funds and what is the quantum of application of funds, and what is the quantum of long-term source of funds, what is the quantum of short-term source of funds, what is the quantum of long-term application of funds, and what is the quantum of short-term application of funds. So in your balance sheet, if you look at your balance sheet tells your balance as on that date. Yes, even using your balance sheet, you can prepare a fund flow statement because even in your balance sheet, you have your current assets, which are receivable within 12 months from the balance sheet date, usually within 12 months from the balance sheet date, your current liabilities, which are payable within 12 months from the balance sheet date, your non-current assets and non-current liabilities, which are receivable or payable beyond 12 months from the balance sheet date. So basically, even using this, you can arrive at your source of funds and application of funds. But guys, does that give a true picture? I don't think it gives a true picture because you're looking at as on date balance. But it would be better if you're able to look at the funds portion throughout the year. Basically, if you're able to see the movement of funds throughout the year, that would give you a better picture. Like, for example, to take a simple perspective, let's say you usually analyze the average of a batsman in cricket rather than looking at his highest score or his score in a particular match, because the average gives a better picture because it gives a record of his performance throughout that particular tournament or throughout his cricketing career, right? So that's what a fund flow statement helps us in doing, because it gives us a better picture. It gives us a higher sample size compared to a balance sheet, which is as on a particular date. So I hope this introduction is clear, guys. So, but now some of you might have a doubt lingering in your head as to why do we even have a cash flow statement then? We can directly go ahead with the cash flow statement, right? Why do we need a fund flow statement? Guys, another explanation to this is that your cash flow statement, as we had earlier discussed in the previous video, in case you're yet to check that video out, you can check that out by clicking the link above. So your cash flow statement is divided into three parts: your operating activities, your investing activities, and your financing activities. So your cash flow statement basically conveys how much of funds how much inflow or outflow you have from each of these activities. Your cash flow statement is basically like three separate films. Like operating activities is one film, your investing activities is one film, and your financing activities are a single film. But I tell you that, sir, I want everything in a single film, like Pulp Fiction. I want a hyperlink story. So your fund flow statement is a hyperlink story because it combines your cash flow statement. It tells how much funds have been provided by your fund providers and how much funds you have invested. But your cash flow statement does not say this. So that is why we need a more comprehensive and a more elaborate statement that interlinks everything like a hyperlink film, which is why we have a fund flow statement. I hope the purpose as to why we have a fund flow statement is very clear, guys. And guys, I'm going to tell you at the end of this video, if you just adhere to whatever I'm saying, I openly challenge you, you will be able to take out any random annual report of any company and be able to prepare the fund flow statement of that company, even if you don't know what that company is even doing, right? So guys, what are you waiting for? Let's just deep dive, sit back, relax, and enjoy as we dive into this concept. Guys, so as we dive in, I just want to explain a few basics before we start. I hope my screen is visible. Just a moment. Yes, perfect, guys. So, guys, I am presenting in front of you balance sheets of three companies: Company A, Company B, and Company C. So, guys, look at this balance sheet of Company A. Long-term sources of funds are rupees 80. Your short-term sources of funds are rupees 20. Basically, your short-term sources would usually comprise of creditors, your bills payable, etc. Your long-term sources would comprise of those funds from your loan providers, your debenture holders, your shareholders, etc. And your long-term uses would usually be the amount that is invested in your fixed assets, um, to the extent of 80. Your short-term uses would be those of your working capital, usually your debtors, your inventory, right? So basically, if you're able to see here, my long-term source of funds are 80, my short-term source of funds are 20, my long-term uses are 80, my short-term uses are 20. So if you look here, you will be able to see that my long-term source of funds is perfectly equaling my long-term uses of funds, and my short-term source of funds are perfectly equaling my short-term uses of funds. So it is a very perfect scenario in the sense whatever long-term source of funds I'm getting from my fund providers, I am exactly investing that in my long-term uses, which is perfectly fine. And the same applies to my short-term sources. So this is a very good scenario. But is it actually perfect? Guys, think about this. Like, you all would have studied something called a current ratio. If you have not studied what is a current ratio, I'll just give you a perspective. Current ratio is basically my current assets divided by my current liabilities. So it tells me that how much of amount is parked in my current asset as against my current liability. So ideally, the current ratio should be 2:1, in the sense that if I have 1 rupee of current liability, I should have 2 rupees of current asset against it. So what is the logic for this? Guys, if you see this company, the company has a current ratio of 1. How do I arrive at this? Basically, my short-term uses, which is my current liabilities, in the denominator, and my short-term uses, which is my current assets, in the numerator, sorry, and my short-term sources, which is my current liabilities, in the denominator. Basically, my current assets by current liabilities, which is basically 20 by 20, which comes out to 1. In this scenario, what would happen is my current assets are neck to neck with my current liabilities. In the sense, let's say if my creditor comes and asks me for a payment tomorrow, I will have current assets to the equal extent, because what would happen is in this 20 there would be some extent of inventory also sitting inside. I would not be able to immediately liquidate inventory and settle my creditor, because for inventory to be liquidated, I need a customer who can pay me the amount for the inventory, and I need a sale commitment in relation to that, which is difficult to get. So in this aspect, if you see, the current ratio is exactly 1, which is not a very ideal scenario, guys. I hope you found this. Next, let's come to balance sheet of company B. Here the long-term sources of funds are 90, the short-term sources are 10, the long-term uses are 80, the short-term uses are 20. So if you look here, the current ratio is 2. Basically, you have current assets of 20 and you have current liabilities of 10. So you have a current ratio of 2. It's an ideal scenario, because if you look here, my long-term sources are 90, my short-term sources are 10, my long-term uses are 80. You would have a question. My long-term sources are 90, my long-term uses are 80. So basically, after I apply a fund of rupees 80 in relation to my long-term assets, I still have a fund of rupees 10 from my long-term sources which are remaining. So what would happen is, if you look at my short-term uses here, I am applying 10 from my long-term sources, which was left over above here, because I had only applied 80. So basically, my short-term uses, if you see this 20, is basically 90 minus 80, which is remaining, plus my 10 from short-term sources, which is usually working capital. So this is how this 20 is basically derived, guys. But is this so? This is how this is basically being derived, guys. Right? Yeah. So this is this good, guys? Is using your long-term sources for short-term uses, is that good? Like, in the sense, let's say I raise funds from my debenture holders for long-term purposes, I'm using it for my short-term uses. Is that good? Yes, theoretically it is not possible, because you obviously need to communicate to your fund holders the purpose for which you're using your funds, and you would obviously use your long-term funds for long-term purposes only. But if you use your long-term funds for short-term purposes, is that good? Yes, it is good, guys, because you need to settle your fund holders maybe after 1 year, but you're getting your funds soon itself, because you're, let's say, investing in some short-term assets. Let's say you're investing in your inventories. You'll be able to liquidate your inventories within 1 year for sure, right? So you are realizing your funds earlier than the time when your fund holders would come to you and ask for their funds. So when your long-term sources are applied for short-term uses, there is no problem in it. There is no problem in it. That is very clear, guys. I hope that is very clear. Next, let's come to the third company, balance sheet of company C. Your long-term sources are 70 and your short-term sources are 30. Your long-term uses are 80 and your short-term uses are 20. So basically, if you see here, guys, my long-term sources are not able to cover my long-term uses. So basically, if you see here, there is a 10 of shortfall, in the sense, just a moment. How is there a 10 of shortfall? Basically, I have 70 of long-term sources, but I have invested 80. How am I able to invest 80? basically what is happening is I have short-term source of 30, but I've invested only 20. So this 10, which I have not invested in my short-term uses, I am investing that in my long-term uses here. So that is how I'm getting this. Basically 70 plus 30 minus 20. So this is how I'm getting this 80, guys. I hope this is clear. So this is a reverse case in the sense that my short-term sources have been invested for long-term use. This is a problem, guys. Why is it a problem? Just pause the video for a moment and think about it. In case you're not able to figure it out, it's perfectly fine. I'll tell you the answer. Let's say I take a bank overdraft for a short-term as a short-term source of fund. Let's say I use it to buy machinery, property, plant, and equipment for the purpose of my company expansion. Again, it is not practically possible, guys. It's only a theoretical scenario. What would happen is, because my bank would definitely ask me the purpose for which I am doing this, and if the bank comes to know that I am going to be using it for long-term purposes, they will not even offer me the bank overdraft facility in the first place. I hope that is clear, guys. So what would happen is, if I am using my short-term funds for long-term purposes, let's say I'm taking a bank overdraft and I'm using it to acquire property, plant, and equipment for the purpose of construction, my property, plant, and equipment itself would take maybe 1 or 1.5 years to get constructed, and the project would take, let's say, 1.5 years to get completed. Once the project is completed, only then will I be able to produce additional output. Only then will I be able to earn an amount. But what would happen is, my bank would come to me within 1 year of time and would ask me, boss, where are the funds that I gave to you in the form of overdraft? I would have no answer to them because I have invested them in long-term assets, which are going to be giving me returns 1.5 or 2 years down the line. So I would have no answer to my bank. So this is the reason why my short-term funds should not be used for long-term purposes. And here, if you see here, my current ratio is below 1. It's 0.67. So this is an indication that if my current ratio is something below 1, it indicates that my short-term funds have been used for long-term uses. I hope that is very clear, guys. Right? So now, coming to the most important and the beautiful part of the video, we're going to be looking at how we're going to be preparing a fund flow statement from start to end. Just a moment, guys. Just representing my screen. Just a moment. So guys, so now we're going to be looking at how you're going to be preparing a fund flow statement from start to end. So it's very, very simple, guys. All you need is just a cash flow statement of a company. So every company will have a cash flow statement in its annual report. You simply need to take the cash flow statement and do a few adjustments here and there, and you will get your fund flow statement. And you will also be able to analyze what is the fund portion of the company in a very simple manner. I'm not going to be going too deep into analysis of the fund flow statement. I'm going to be only analyzing the end result of the fund flow statement, because there are a lot of videos on YouTube which convey on how to analyze a fund flow statement line by line, word by word. So I'm going to be just telling you how to prepare a fund flow statement from start to end and analyze the end result of it. I hope that is very clear, guys. Right? So guys, if you look here, I'm going to be starting with my cash flow statement of a company. So this is a company called Go Fashions Limited, whose cash flow statement we had prepared in the previous video. In case you're interested in learning how to prepare a cash flow statement from start to end, you can check out the above video, and that will offer you a lot of insights and a very good perspective. So after checking out the video, you can come to this video. It is better you do so, because I'm going to be explaining the fund flow statement for the same company, and it would be better if you're familiar with the cash flow statement. Even if you're not familiar, you can try to follow the same, and I hope you will understand if you follow attentively. All right? Yeah. Just a moment, guys. We're just going to the fund flow statement. So guys, before we start going into the fund flow statement, I have to tell you that there are two sources of funds: long-term sources and my short-term sources. So basically, as we looked earlier, if my short-term sources are used for long-term purposes, it is an issue. But if my long-term sources are used for short-term purposes, it's not a very major issue. It's not an issue at all, as a matter of fact. So that is fine. So guys, if we just come here, this is the cash flow statement of the company. This is the cash flow from operating activities. This is the cash flow from investing activities, and this is the cash flow from financing activities. So guys, how are we going to start this fund flow statement? So first, let's arrive at the long-term sources of finance. So basically, if you look at this cash flow statement, 90% of the cases, whatever items are there in your investing activities, they would be in relation to your long-term items. And similarly, in relation to your financing activities, in 90% of the cases, they would be in relation to your long-term items. Yes, there are exceptions where they would be in relation to short-term items as well. So just keep that in mind before we start the fund flow statement, right? So guys, fund flow statement. So first we will take the net profit. What number are we taking here as the net profit? So we are not directly taking the profit before tax for the year. What is the reason for that? Guys, if you know a cash flow statement, you will know that your depreciation will be reduced in arriving at the profit for the year. Your write-offs will be reduced in arriving at the profit for the year. But ideally, these are non-cash items. These shouldn't have even been reduced in the first place. So we should ideally add them back while doing the cash flow statement. And basically the number which we are taking here, that is the number which has been adjusted for these non-cash changes, which is basically 27,551.12, which we are taking here. So that is the number which we have taken here, and that is the starting point. So why am I calling profit a long-term source, guys? The very simple reason being that what is this profit? This is the amount remaining as profit in my, this is the amount that is available for distribution to shareholders. So who are shareholders? Shareholders are people who ideally want to be looking to be invested in my business for a long time. So they want to have a long-term association with the company, which is why we are considering my net profit to be a long-term source of finance. So basically that is the reason why we are doing this, guys. Next, let's come to the other long-term sources. So let's look at my non-current assets. So my non-current assets, if you see, my non-current assets have reduced by 23.9. So if you have reduced by 23.9, it indirectly means that I have realized these assets due to which they have reduced. So it is an inflow for me, which I have considered above as a long-term source of finance, because it is an inflow of funds to me and it is a source of finance because I have sold my non-current assets. Then proceeds from disposal of property, plant and equipment. This number, I've taken this number from the cash flow statement as 32.77 right away from the cash flow statement of the company. So I am attaching this work paper below and the cash flow statement of the company below as well. So you can refer the same, and you can also reperform it. In case you have any doubts, you can just comment that down below and I will clarify the same. Right? Cheers. So this is 32.77. Or what I will do is, guys, I'll just unhighlight all these. So I'll just highlight the numbers as and when we complete them, so that we have a track of what we are doing, right? That would be better. So I'm just unhighlighting all of these screens so that we have a track of where we are with regard to each of these numbers and how we are using them. Just a moment. Just a moment, guys. Yep. So first we took this 27,551. This is already considered in the fund flow statement there. That is done and dusted, which is done. Next, our non-current assets to the extent of 23.9. So you will not be able to trace that here because in your working capital changes, this is considering the current and non-current assets movement. So you will not be able to trace that here. We will take that towards the end when we take the total of the current and non-current assets for your comfort. So proceeds from disposal of PP, 32.77. When I'm selling property, plant, equipment, I'm realizing an amount which is an inflow for me, which is a source of finance, which we are tracing below in the investing activity, 32.77. Right? This is done. Next, interest received on fixed deposits during the year. So again, this is a long-term source of finance because this is in relation to fixed deposits I had invested for more than 1 year, which were non-current in nature. So this is again a long-term source of finance for me, 1728.33. Right, guys? So this we have again taken here, which we have ticked here. Right? Next, let's come to purchase of PP. Purchase of PP is a long-term application because my property, plant, equipment are usually procured for the purpose of my business expansion. So if I come here, 399.1.94, which I've taken here again. Next, purchase of mutual funds, 275.46. Again, so these mutual funds are again a long-term application because I'm using the funds which I've received from my long-term sources for the purpose of investment, because on mutual funds, I will be receiving dividend as an income on the mutual funds when the funds pay out dividend. So it is again a long-term application of the funds. Then FD placed with the bank. So again, this FD is matured. So since this FD is matured, the bank is repaying the amount to me. This FD is not matured. This is an FD placed with the bank. So I am giving my money to the bank and placing it as an FD. So this is 4,600.76, which is again an application because I am paying to the bank, which is an outflow again. Then security deposits given during the year. So I am basically giving security deposits to the counterparty, which is again an application because I'm paying the funds to the party, which is again an outflow, which is again linked here. So which is done. So which we have got here, 455.53. Then my payment of lease liability. So basically when I'm paying my lease liability, my lease is usually taken for a longer period of time. It is not a short-term lease usually, because my short-term leases are usually expensed off in my P&L. So it is usually a lease which is for a longer period of time. So it is a long-term application. So I am paying this amount for the use of the lease facility for a longer period of time. So I am taking this as a long-term application of my funds, 12,254.83. So I arrive at my long-term application, guys. So these are the numbers which we have already greened out in our working. Next. So this is our net long-term sources. So if you see this, guys, we have an excess of long-term sources after our long-term uses. So as we had discussed earlier, when we have an excess of long-term sources over our long-term uses, we will use this surplus to meet our working capital deficit or or our current asset, current liability deficit. That is how the trend has usually been, as we had discussed earlier and seen in our examples. So let's just come down a bit. Let's come to working capital changes. So working capital changes, I saw my inventory 2174.74, which I've exactly taken there. Everything is linked here. Next, my trade receivables 2577.48, which again I've taken here. Next, my decrease in other current assets, 108.25. So basically this 108.25 plus the number which we had taken above would equal to 132.15. 108.25 here. Then we have 23.9 here. Yes, so it is equaling to 132.15. So I am highlighting this. So we had segregated this because this was current and non-current, which was the reason why we had basically segregated this case. Then my trade payables 234.92, which is fully current. I'm taking it here. Then my provisions. My provision has a current and non-current component in it, but I saw that the current component was not material. So I directly taken, the non-current component was not material. So I taken everything as current. You can, if you want, split it into current and non-current, but the impact won't be significant again on your fund flow. I've already gone through that. 288.34, which I've directly taken here. Income tax paid 3578.16. So which I've taken here as an outflow, because I've taken this as an outflow because it is concerned more with my operations and more with my day-to-day activities, because my day-to-day activities are what are ultimately generating my profit. And so I am considering my income tax paid as a short-term application of my funds. Then my finance, because I have to pay tax every year, right? So that is why I'm considering it as a short-term application of my funds. I hope that is clear. Next, my finance cost paid. So why am I taking finance cost in current? As I told you earlier, 90% of the items appearing in my investing and financing activities would usually go in my long term. But why am I taking the finance cost as short term here? The reason being that when I went to the annual report of the company, I saw this finance cost was in relation to cash credit. And cash credit was short term, actually, when I had read through the annual report, which is why I'm considering it here. Again, it's not a very material amount. You can take it in either of the places. It won't have a material number impact as such. So if you see here, guys, for working capital, we are not splitting into short term and long term. Like we are just looking at the sign and we are seeing which is a net inflow or an outflow. Like when there's an increase in inventory, it means that I have paid amount to purchase inventory, which is a deemed outflow. Again, for the logic of why it's a negative sign or why it's a positive sign or why it's a deemed inflow or a deemed outflow, I've explained it in the cash flow video, which you can just click above and decode the same, right? That is that. So if you see here, guys, we have a surplus of 7757.60 from our long-term sources. And we have a deficit in our working capital to the extent of 7718.06. That is, we have an outflow in our working capital to the extent of 7718.06, which simply means that I have a surplus of long-term sources which I am using to meet my deficit. So here we are using our long-term sources to meet our short-term application, which is perfectly fine, as we had discussed earlier, and we also discussed the logic for the same. So if you see here, after applying 7751, I only need to cover a deficit of 7718. So I am applying funds of 7751 against 7718. So after I settle the deficit of 7718, I still have 39.54, which is left in my business, which will be the movement in cash and cash equivalents in my cash flow statement, which you can trace here, which is basically the movement in my cash and cash equivalents. So this is the fund which is remaining idle, in the sense because I have already covered my deficit. I'm just parking this in my business. I've not invested it anywhere, which will match with my net increase or decrease in cash and cash equivalents with my cash flow statement. So guys, this is how you ideally prepare a fund flow statement from a cash flow statement. This was the simplest way in which you can do this, because as I told you earlier, the balance sheet, using the balance sheet also you can prepare a fund flow statement, but that would reflect the as on date portion, and that would not be a very, very elaborate picture. To get a better picture, it is better that you proceed from the cash flow statement and you arrive at this. So the crux being that, as we saw earlier, most of the items in our investing and financing activities would either be in long-term sources or long-term application, and almost all the items in our operating activities would be in our short-term sources and short-term application. You just need to bifurcate the amounts in this way, and you would get an understanding of what is happening and how the things are happening. So let's just discuss a reverse case here. I'm just going here. So we are seeing that let's say my long-term application was more than my long-term sources. So, and let's say my short-term, let's say I had a working capital net inflow. So if I had a working capital net inflow and I had a long-term deficit, so what would happen is, in that scenario, I would be applying my inflow, my short-term sources for the purpose of long-term assets. But would that be good, guys? No, guys, that would not be good when I'm applying my short-term sources for my long-term application, because it would lead to a scenario where I'm not able to pay back my short-term fund providers, right? That is what we had discussed earlier. So guys, I hope you found this video insightful. You will be able to get a better perspective on this video when you look at the cash flow video, because we use the cash flow as the base to prepare the fund flow statement. So you would get a better understanding when you click the video above and look at the cash flow statement. So guys, I hope you all found this insightful. For more insightful videos, do hit the subscribe button and do comment down on what video you want next. So guys, keep learning, keep growing, and do hit that subscribe button. A lot of content is brewing and it's on its way. So stay tuned. Thank you so much. Cheers. Thank you.